morning. You're very welcome to our second macro financial review media briefing of the year. Let me turn just to introduce Mark Cassidy, our Head of Financial Stability, our Deputy Governor, Sharon Donnery, and our Director of Credit Institutions Supervision, Ed Sibley. So Sharon will open with some remarks, and I can hand over to Sharon, please. Thank you.
Thanks, Jill, and thanks everyone for coming along. So today, as Jill mentioned, the bank is publishing the second edition of the 2016 Macro Financial Review, which provides an overview of the current state of the macro financial environment in Ireland. The review aims at supporting our stakeholders, including the public, national and international authorities and financial market participants in their assessments of financial risks. And it also provides an opportunity to promote an informed dialogue on the macro financial environment in Ireland and beyond. And it thereby contributes to the bank's mission of safeguarding stability and protecting consumers. The immediate impact of Brexit on the euro area has been relatively muted. Nevertheless, the considerable uncertainty on the outcome of the negotiations between the UK and the EU constitutes a large downside risk to the euro area economy. While it's too early to assess fully its impact on the Irish economy, downside risks to the domestic economy prevail over the medium term, given the extensive linkages between Ireland and the UK. A number of further risks to European financial stability also arise. The threat of simultaneous corrections across asset classes persists, given compressed global risk premia in financial markets and macroeconomic uncertainty. Furthermore, persistent low interest rates pose a challenge to the profitability of both the banking and insurance sectors. In the financial sector, the high stock of non-performing loans continues to constrain the lending activity of European banks. And finally, public and private debt in some member states remains high, thereby increasing their vulnerability to both economic downturns and tensions in financial markets. In this context, as set out in our last quarterly bulletin, Irish GDP is projected to grow by 4.5% in 2016 and by 3.6% in 2017. Domestic demand is expected to be the main driver of growth over the forecast horizon, reflecting in part a positive outlook for the labour market and expected investment in infrastructure. The balance of risks to the Irish economy, however, is tilted to the downside, owing to Brexit and uncertainty surrounding international trade, high public and private debt, and the susceptibility of the economy to external shocks. Overall, credit conditions remain subdued, although a rise in new lending is now evident. And against this background, the Central Bank has decided to maintain the countercyclical capital buffer rate on Irish exposures at 0% in the first quarter of 2017. Turning to specific sectors, today's publication shows a less positive outlook for the non-financial corporate sector compared with the review published last June, with the decision of the UK to leave the EU posing a substantial downside risk to it. This sector is expected to see a direct impact of Brexit on trade due to weaker foreign demand and the strengthening of the euro against sterling. In addition, the ongoing uncertainty could act as a drag on investor confidence, and in the longer term, greater barriers to trade could materialise. Financing conditions for non-financial corporations remain restrained. The overall stock of credit declined, with an annual rate of growth of minus 5% in October 2016, and such a trend reflects loan repayments driven by SMEs continuing to outpace new lending. Nevertheless, gross new lending to SMEs reached its highest levels in the second quarter of 2016 since 2010. In the household sector, despite the deleveraging that has been occurring in recent years, debt remains high. Its distribution varies by household age cohort, with the 35 to 44-year age cohort being relatively highly indebted. There's continued momentum in the decline in mortgage arrears, and mortgage accounts for principal private dwelling houses in arrears fell in the third quarter of 2016 for the 13th consecutive quarter. Turning to the housing market, residential property price growth has declined from recent peaks. Disparities arise between Dublin, where prices have increased 5.4% in August 2016 year on year, and outside Dublin, where prices rose 11.4% over the same period. Rental growth also remains strong, with regional variability arising. And while residential construction activity is increasing, annual new supply does not meet projected long-term demand. At the end of November, the bank announced the findings of its review of the macro-prudential mortgage lending requirements. And the review confirmed that the overall framework is appropriate and that the mortgage measures have been implemented successfully. Nevertheless, some limited refinements were implemented to improve the effectiveness and sustainability of the framework. And among those, the €220,000 threshold has been removed for first-time buyers, meaning that first-time buyers can borrow up to 90% of the value of their homes. The 3.5 times loan-to-income limit remains unchanged, and this anchor remains firmly in place and is key to ensuring that mortgage commitments are not too high relative to income levels. Returns on Irish commercial property continue to decline in the first half of 2016, but remain higher than those in other countries. And rental values are rising as a shortage of supply, especially in Dublin, is becoming evident. Investment by non-resident investors is also vulnerable to global economic and financial uncertainty, as well as to alternative investment opportunities elsewhere. Turning to the banking sector, net interest income of Irish retail banks declined marginally in the first half of 2016. Credit quality is improving, and the stock of non-performing loans held by Irish retail banks declined by €15.6 billion over the past year to stand at €37 billion in the third quarter of 2016. The reduction of non-performing loans has occurred across all major loan categories, with commercial property portfolios experiencing the strongest decline. Nevertheless, there is still much to be done to reduce the high stock of non-performing loans, which is constraining the activities of Irish banks. And while the low interest rate environment has contributed to a reduction in banks' funding costs, it also poses a challenge to the profitability of Irish banks, with interest income falling, given shrinking loan books. Given the international nature of its business, the non-bank financial sector is exposed to adverse developments in the global economy and the international financial system. Although the Irish domestic economy has limited direct exposure to this sector, any adverse development to the activities of funds based in Ireland could cause reputational damage. Looking at the insurance sector, the domestic non-life insurance industry continues to experience operating challenges. All the domestically focused high-impact non-life firms reported underwriting losses in the first half of 2016, albeit at lower levels than in the same period of 2015. And those losses are mainly concentrated in the motor insurance market. Moreover, the sector has also been affected by the low interest rate environment, with interest income falling over time. Nevertheless, the overall solvency position of the non-life sector remains high. Domestic life insurers are also well capitalised and are benefiting from improving economic conditions. The domestic life firms have little direct exposure to the UK in terms of business written and investment holdings, but may be affected by any adverse effects on the Irish economy from Brexit. So thank you for your attention, and we're now at your disposal for questions.
So if we can open up with any questions. Yes, Conor Humphreys, Reuters. Yeah, yes, I think where's the microphone?
Sorry, there's no microphone.
There's no microphone, sorry. Don't mind, thanks.
Just interested in the issue of insurance companies looking to move to Dublin from London, or looking to Dublin as an alternative to London. So I wonder, have any of the firms who are interested sought authorisations yet? And when do you think that most of these authorisations are likely to come through? And can you give any more detail on how many people, how many firms have expressed interest?
Yes, I'm not going to get into the exact numbers of firms and so on, but I think we've said a number of times over the last few weeks that we have had a number of inquiries and are engaged with a number of firms about the potential for them to move here. I think we've also been commented publicly that a number of the legal firms, accounting firms and so on are experiencing some inquiries. I think we've set out very clearly over the last number of weeks the authorisation approach that we have. I mean, in general terms, for most sectors, we operate in a European context, and many of the regulations and so on that are set out for firms are set at a European level. So firms will be well familiar with that. Our authorisation standards generally are publicly available. We think we have a clear and transparent process, and firms understand what that process is. We've also been clear that there may be implications for us as an organisation in terms of staffing and so on, and we're prepared for those eventualities. I don't know if you want to add anything else. I think you spoke about it briefly as well recently.
So most of our engagement to date has been from a fact-finding perspective, so firms engaging with us and looking at the jurisdiction as a whole. Our expectation, or in fact our experience in recent weeks, has been those discussions are tending to harden a little bit towards getting closer to a point of decision making, and we'd expect into Q1 and Q2 next year that perhaps we would actually start to see more definitive determinations around actually making decisions around the jurisdiction to relocate to.
In terms of is there much interest from reinsurers as well as insurance firms?
So I'm not going to comment on the kind of individual firms or sectors that we may be discussing with, but we've had inquiries from a wide range of firms, I would say.
Thanks very much. So John Walsh from the Times Ireland edition.
Could I just ask you, the government's proposals to curb rental inflation in the rental market, from what you've seen so far, what do you think the likely outcome would be, the impact on the market from the proposals published?
Well, we haven't had any kind of formal discussions about the proposals, and I obviously don't want to get into discussion about current political discussions that are going on. There's no proposal or legislation has been introduced as of yet. I think we've been clear in the discussions we had around the time of the mortgage market measures a couple of weeks ago, and also in the report today, that we see obviously increases in rental prices. It varies across different parts of the country, and these are part of the considerations that obviously feed into our analysis of the housing market. I don't know if you want to add anything in terms of particularly the variability and so on in rents that we've discussed in the report today.
No, we always give an analysis of rents. Rents have been increasing consistently for the last 3-4 years by around 10% per annum. Unlike house prices, they are now above the levels they were at the peak of the crisis. They're probably above what is warranted by fundamentals. At the time of our review of the mortgage market measures, we produced quite a lot of analytical work underpinning this. But we wouldn't comment on individual policy measures, particularly what is currently a proposal.
Just ask about mortgage debt, and the review sort of states that those who haven't received a treatment from the bank, they're mostly people in very long-term arrears. Just wondering what you're expecting in 2017 and how banks might deal with these cases. Are we likely to see a step up in court proceedings, repossessions, etc., or what do you think about it?
I think the general policy stance set out by the government over recent years has been that all stakeholders are working to keep people in their homes in as many cases as possible. I would say all of the measures that the bank has introduced over recent years, be they our codes of conduct and so on, or the engagement that we've had with the banks that we supervise in terms of targets and so on, have had that objective at the heart of them. We've put a huge emphasis on the sustainability of arrangements. Earlier on, post the crisis, we would have seen an awful lot of short-term arrangements which really weren't suitable. I think into the longer term we've seen a big move away from that. We've published quite extensive data. There's data in the report today, but also our normal mortgage arrears data and so on, which I think show that there is momentum now in terms of continued decrease in arrears at an overall sector level. Clearly some very difficult cases remain, particularly the ones you mentioned of very long-term arrears. And also we see, I think, a number of cases around non-cooperating borrowers. So I think in those cases, unfortunately, some will end in repossession. But in general, even where we have seen homes being taken into the possession of banks, they tend to be voluntary surrenders or arrangements that are made voluntarily with the banks. Want to add something on that?
I think what we can see is that those that are currently in the legal process are those that are in very, very deep arrears, or those that are not cooperating, so or not engaging with the bank. So a very, very substantial majority of borrowers in that circumstance are in either of those two categories and a combination of both. So we would strongly encourage that there is continued attempts to engage between bank and borrower, But in certain circumstances, the legal process will inevitably end in some repossessions.
Sorry, I don't have the number to hand, but I mean, there are thousands of these long-term cases, aren't there? I mean, there's a huge number.
Well, there's certainly. I mean, since the start of mortgage arrears growing, so say around mid 2009 to the current day, there have been about 6,000 homes that have moved from borrowers to banks that have been repossessed. 2/3 of those have been through, as Sharon describes, voluntary, so either voluntary surrender, just handing back the keys. Now there are more than those 6,000 still in the legal pipeline, but the vast majority of those are in very, very deep arrears and typically not engaging with the bank.
I think I would also add, I mean, we do publish data. I don't have it here today, but we do have it available. That when people do engage with the bank, even if they are in significant difficulty and deep arrears, that the range of options that are available now for people to restructure is quite comprehensive, and we see that around, I think it's 88%, but close to 90% of restructures would have people paying in accordance with their restructured arrangement. So I think we would emphasise that even where things may look particularly serious, engagement really is key to finding a solution. So.
Can I just ask you, in terms of the stock of non-performing loans still on the books of the banks, and I know they've made a lot of progress in the past couple of years on this, but Bernard Byrne, when he was in front of the Oireachtas Finance Committee recently, he said getting down this ratio of non-performing loans is a big focus of the ECB, and he said it was going to be a big focus, I think, next year and the year after. I think it's around 17% or something, when it should be around 5 or 6 or thereabouts. So again, just wondering if that's going to be a big focus for the regulators in terms of retail banks. He also kind of suggested that they've more or less worked through the commercial stuff, that they really need now to get going on the residential non-performing loans. They need to sort of find cures for them, some way of dealing with them.
Yeah, so I don't comment about that particular bank. What I would say about the banks in general is that, over the last number of years, different banks have made more progress in different sectors. So in fact, the situation for the banks now in terms of what their own internal priorities need to be, working out their non-performing loans, varies, particularly according to the types of books that they have and whether they've sold portfolios and so on. I think both the Central Bank of Ireland and the ECB, wearing its banking supervision mandate, have been absolutely clear that non-performing loans is a very high supervisory priority. The Central Bank of Ireland is actually leading a significant amount of work at European level on working out non-performing loans. The ECB has recently published for consultation requirements for banks on non-performing loans, which is going through the consultation process at the moment. So I think it is and remains a very high priority both for us here and for the ECB.
Sorry, I ask in the context of there is a concern that maybe one way of curing this problem for the banks might be to package up some of these troubled loans and sell them onto a so-called vulture fund, and certainly the politicians would be concerned about that.
So I think there are many solutions for banks for dealing with non-performing loans. We've seen solutions here ourselves in terms, for example, of the establishment of NAMA, and a number of other countries have similar asset management agency type approaches. But I think we have also been clear over recent years, and the ECB guidance in particular is clear, that at the end of the day banks have to knuckle down and do the hard work to work out these loans if they keep them on their books, and that requires them working through arrangements with individual borrowers if they're retail borrowers, or with large commercial firms or whatever, and that work takes time, but it has to be done, and banks need to focus their efforts on making sure that that gets done.
And just to go on and say that the protections of the CCMA travel with the borrower and a borrower in arrears.
Thanks very much. Do you have any additional questions? Dara Doyle from Bloomberg.
One question I had was an interesting line buried in the report about the possibility that UK banks operating in Ireland, their ability to continue to operate in Ireland depends on the outcome of the Brexit talks. So is there a suggestion, so you're an unnamed UK institution already in the Irish market, is there a real life possibility that these guys may not be able to operate here post-Brexit?
So the UK banks operating here through a subsidiary, so have a banking license, would be well, from a legal right to operate here, would be unaffected by Brexit. If they're branching from or passporting from the UK to Ireland, then depending on the arrangements that are agreed in the negotiations around Brexit, and that may well be impacted. So they will have to consider if they want to continue to operate in Ireland, how that works.
That's not unique to Ireland, I would say.
No,
So
no.
that obviously affects banks that operate using the passport in any other country either.
And both ways. So
So if you're a UK bank operating with a full banking license, there's no issue.
No.
But if you're a UK bank here operating a financial passport, is it?
So
if you're a UK bank operating with a financial passport, or sorry, did you say a branch here?
So it's the same thing. So if they are using the rights to passport to provide services across the European Union, which is called through branchings, then that will be impacted. Could be impacted, not necessarily just for Ireland, but for any other European Union country.
Right.
I think that's the key thing. I wouldn't want to miss that. We're not saying that this is a certainty. We're saying this could be impacted, and it depends on the rules around equivalence and passporting and so on that will be agreed.
Fair enough. But would most UK banks here be operating with a full license, so it's not an issue, or are the majority of them operating facing this possibility that they could lose access?
So there's a mix of operations here. So there's several subsidiaries, and there are several branches. All relatively small.
Is it possible? Is that sort of public information now?
Yes, it is. Yeah.
It is.
The lists of banks are available. Yeah, we can. Yeah.
Okay.
So we have those that are authorised on a banking licence basis, and those that operate on other bases. But this would include some of the international banks as well.
Is that on the website?
Yeah.
We can provide that, yeah.
That's
Yeah.
So you mentioned staffing issues just a while ago. Is that putting a constraint in terms of the people you're capable of speaking to at the moment?
In terms of our engagement with firms that might want to come here, no, I wouldn't consider it's a constraint at the moment. I mean, I think the issue that we've mentioned previously publicly is that if and when applications arise, then there's obviously work to be done in terms of processing those applications, dealing with those firms, and then obviously the ongoing supervision of those firms if they do ultimately decide to move here. But I would say for the moment, in terms of dealing with firms and their inquiries, there aren't any issues.
I mean, it's been well documented that you've had problems recruiting staff, particularly in the regulatory function. What would you say is the biggest stumbling block to taking people on from the private sector?
So I think we've experienced fairly significant turnover over recent years, particularly as the labour market in general has improved. And there are more attractive opportunities for people, particularly in the financial services sector, as it has begun to grow again post the crisis. So it can be difficult, I think, for us to both recruit and retain people in terms of competing with salaries that are available elsewhere. And we've commented on that, I think, a number of times. And our turnover levels, I think, are probably published in our annual report.
Have you any sense of how many additional staff you might require if a number of firms relocate somewhere on with their operations here as a result of Brexit?
So I think it depends ultimately in terms of the mix of firms that come here and the basis on which they come. So clearly the approach for supervising a bank, for example, versus supervising a fund is somewhat different in terms of the resources and so on that are required. So we'll have to continue to evaluate that over the coming years. But I would emphasise, and the Governor has commented on this publicly as well, that we are fully alive to these issues and are looking at them actively, and are already looking at staffing arrangements for next year in terms of if a wave of authorisations come, how we will manage that.
But I mean, would it be fair to say that as long as the pay caps are in place, you're going to find it quite difficult to get the staff you need?
I think we've managed to grow the organisation somewhat over recent years. I mean, I think even this year, I don't have the number to hand, but there's been a net increase of 115, a net increase approximately 115 staff this year. So we are still managing to increase our staff on a net basis, notwithstanding some of the challenges that we have.
Thanks very much, Conor.
Just on the housing, Mark mentioned that the high price of rents. Is there any fear that the cost of housing is undermining competitiveness of the general economy?
Want to mention that?
Well, it's certainly an issue. Housing, property market developments are a factor in competitiveness. I would say in terms of the level of housing, while we have seen some increases in prices recently, our analytical work would show that the level of house prices is not above what is warranted by fundamentals. And the rate of increase, of course, has moderated, price expectations have moderated. So the recent developments have been more welcome, but I think supply shortages in the market are probably the key concern at the moment. We have seen a number of measures introduced to try to alleviate supply pressures. This will take a couple of years to come on stream, and I think that will be the main factor in terms of maintaining competitiveness as it is related to the housing market.
So in terms of rents, what kind of time frame do you think they might start stabilising?
We don't forecast either prices and rents. They're determined by a number of factors. They're both very much interlinked, so developments in the residential market will impact developments in the rental market. Supply will hopefully come on stream relevant for both markets, but at the moment, in the short term, we have a situation where nominal incomes are improving and there's a time lag for supply development, so that's impacting on dynamics in the market over the next year or two. After that, we would hope to see things stabilise, but we don't forecast either of those because there are too many factors.
Thanks very much. Just wondering, are there any final questions?
Can I just ask about the insurance sector, maybe any sense of when they're going to return to an underwriting profit?
Well, again, I think as Mark said in answer to the previous question, we don't kind of forecast in relation to that. The report does call out, I think, some of the pressures that are on insurance companies, including from the low interest rate environment at present.
So do you have a concern that different parts of the state have, I suppose, are introducing policies that effectively undermine each other? I mean, with the central bank rolling back and the first-time buyers, or the deposit for first-time buyers, with the state introducing a first-time buyers grant and also potentially rent caps, that the various impacts of these measures are actually negating each other.
So the first thing I would say is I don't consider that we rode back on the measures. I think I mentioned in my opening statement today, and the Governor also mentioned when we announced the changes, that we were introducing some limited refinements. I think it's critical to emphasise that the 3.5 times loan to income anchor remains in place, which is a fundamental part of the system. In relation to other policy measures, I mean, the mandate of the bank is the overall financial stability of the state, safeguarding stability, and also our consumer protection mandate. The policy measures that we introduce are oriented towards making sure that we fulfil our part of that mandate and that they're particularly evidence-based. In terms of the government and measures that the government may wish to introduce, I think we are clear at all times about the importance of a prudent fiscal stance and so on, but ultimately it's a matter for government to decide if it wants to spend taxes or introduce different measures and so on, provided that is in the context of an overall prudent fiscal stance, which would be what we would be most concerned about.
Okay.
Looking forward to moving to your new building.
Yeah, so a number of staff moved in last week, actually. The first kind of people moved in. So all of the arrangements, I think, are getting underway now for the practicalities of it after Christmas.
I missed this view.
Yeah, we will, for sure. Yeah.
Which probably brings us to a nice ending to say that the next macro financial review obviously will be held in our new building. So we look forward to welcoming you there, and wish you all a very happy Christmas as well. So thank you.